The dramatic silence. I love it.
I know.
Yeah.
The problem is if we start talking right away, that thing starts echoing on the. So thank you very much. Yonah Weiss is joining us tonight at the weekly Multifamily Roundtable. And Yonah is a cost seg expert from Madison Specs. And we're going to talk about all kinds of things cost segregation tonight. Welcome to the show, Yonah. Sorry.
It's all good. Thank you, Rodney, Dan, Anthony. It's my pleasure to be joining you guys. This has been on my list for quite a while. But Rodney, you asked me a while back. But as you know, I usually have a prior commitment on Wednesdays, which this week got moved to Tuesday. So I figured I'd jump on the opportunity.
Yeah, we were just talking about that. You can say that you have a meetup. Yonah has a great meetup on Wednesday nights, same time we do. So we don't want to hog everybody.
Well, we're about to be starting an hour early, so soon it's going to be a different time, same day.
Yonah forced us out of our time slot. We had to shift because he's just taking couldn't keep up.
Nobody's watching our show, so we're like, hey, we got to move off of Yonah's time slot here.
So for those of you guys at home who've never heard of Yonah Weiss, he's I would say LinkedIn famous as the cost seg king. I'm curious, how did you get crowned the cost seg king? Did you have to how do you get that title?
Someone just threw it at me at one point, and it kind of stuck. And when it comes to LinkedIn, the whole piece of LinkedIn and social media in general, but specifically LinkedIn, it's all about branding, right? Mm-hmm. It's all about personal branding and making sure that, when you're posting or you're active on the platform, people remember you if you're active, but you want them to remember you in a specific way that relates to your business and how you can help them. So when when people just say my name, they may have no idea what cost segregation is, but they relate cost seg with me. That's called branding done right. And so someone just threw out, cost seg king on LinkedIn for the past couple of years. There's been basically, I've been having 90% of the content on LinkedIn about cost segregation. So it kind of was self-anointed, but I coronated myself.
I love it. I love it because your content, I think of you and I think of two things. I think of value oriented and I think of cost segregation, because you're always giving a lot of value on social media, on the platforms. And then as a consequence, you're linked in my brain as the cost seg king. So It's working. Good job.
So how did you get into the business? Were you somehow related to multifamily before you got into the cost segregation side of things, or what's your backstory?
Yeah, I wasn't so into multifamily beforehand. So I really, my kind of into the cost seg world came with the company that I worked for. So Madison Specs, Madison Commercial Real Estate serves as a larger kind of umbrella company. Madison Title, you may have heard of, also big title agency. What happened is my background is really in teaching. I was a teacher for about 15 years. I love that. And I don't really I didn't know much about real estate at all until about 5 years ago. And I kind of just immersed myself in real estate in general and came across, a lot of people in the commercial side of things, whether multifamily or in other sides of the business. And I just kind of got my feet wet, started learning everything I could. And one thing led to another, and I found this company, and they were looking to hire someone to work on the business development. And I was like, okay, we'll do this. And one of my greatest skills is, because I was a teacher for so many years, to learn things and be able to give them over, kind of disseminate that information in a very simplified way. Mm-hmm. And, I hope to be, in an engaging way, which was kind of a perfect fit, because cost segregation is a really dull topic. And most of the people who are in the industry, no offense, but they're accountants, engineers, and not necessarily not necessarily the people you want to sit next to at the party, right? Yeah. But all of a sudden, I just started spicing it up and just giving content, and you just kind of spreading the word about it through podcasts and through, social media and stuff. And it kind of caught fire to the point where cost segregation became a household name. I mean, I don't know if it has to do with me as much as just the market in general kind of taking off in the past few years. But I like to think that I had a good contribution to that.
Yeah. Well, I think it probably comes down to the fact that you come from an education background, and that's what, Anthony and I really focus on with our content. It's just educating people. We're not trying to really
Right.
sell anything per se. We're just trying to share the wealth of the knowledge, and then you combine that with your charisma, and that's probably why we've got the cost segregation gig now. You can educate people and keep them engaged with some level of entertainment at the same time, and it's a powerful combination. I love it.
Right.
Well, one of the things.
How long have you been with
Go ahead.
how long have you been with the company now? Has it been a long
So
time? Because
I've been doing that for about 3 years. 3 years, yeah.
Okay.
So, Madison Spec's been in business for 15 years, and the executives and people that started the company were doing it for a decade before that. And so there's a lot of kind of industry expertise that I learned from the best. And basically all my questions that if not a daily basis, on a weekly basis, I'm talking to the CPAs and the top guys in our company, just all my questions, everything that comes up, just kind of continually learning more, and it's been very productive.
Mm-hmm.
Well, one of the things that we want to do is not assume that our audience knows what cost segregation is.
Right.
So
Assume I even know.
Yeah. So could you give us basically a bird's eye view of what cost segregation is?
Absolutely. And it's, besides for the fact that it's a weird name, right? You just have to, the first thing you need to know is that this is probably one of the best income tax savings tools that exists. Regardless of real estate in general. The fact that real estate investors get this tax benefit is a conversation into of itself, but it is just huge. So that's the first thing you need to know before you even know what it is. Why is it so important? Why is this so cool? Why do we even dedicating an entire conversation to this? But to take a step back, we have to understand what depreciation is. And you may have talked about it before, but I'll just kind of give a brief overview, because depreciation is really, cost segregation is just like an advanced form of depreciation. It's just like taking depreciation to the next level. And when you understand what depreciation is and then how a building depreciates, what that means even, and what the tax deduction there is, you'll understand very clearly what cost segregation is, how it works, and then we can just go home and have a good night.
Then we're done.
All good.
But so depreciation, right? It's like a negative thing, right? You think depreciation, something going down in value, right? And as time goes on, things go down in value. Things have a useful life, and there may be some intrinsic value that's going down. But sometimes it's not really intrinsic. Sometimes it's just like a theoretical value devaluation. For example, when you drive a car off the parking lot, everyone understands that when you go from here to there, 10 feet later, the car automatically has devalued. Intrinsically, it hasn't, but the fact that you now took it off the lot, it has. So too with property. Even though we know property, right, real estate is going up in value usually as time goes on. In fact, it's probably the only investment vehicle that I can think of that is intrinsically going up in value as time goes on.
You still get depreciation.
Right. Well, you don't have to do anything, and yet the property is going up in value. Nevertheless, the IRS gives you a tax deduction based on the principle that things go down in value as time goes on. And so they say, you bought a building, now you get to take the entire purchase price, right? Subtract a small amount for land, because land has its own value and you can't take that as a tax write-off.
Nope.
Frozen.
He is frozen.
Quickly, Dan, do a dance. Distract the audience. Oh, wow.
That's all I got.
He actually did it, Mr. Introvert.
Yeah.
One of the craziest things about real estate and the tax situation, and the whole being able to take depreciation and appreciation, is that we both simultaneously get appreciation and that depreciation. So
Yeah,
I was just trying to fill the void while Yonah came back.
I don't know what happened there. Where did you last leave off?
We got up to the point where you said that you can't
Depreciate
include land.
Right. So land doesn't depreciate, but whatever's left over, now you take that as a tax write-off over a 27.5-year period. I'm wondering why you guys weren't reacting to my jokes because you didn't hear me. but basically what I said was the proof is in the pudding. You didn't hear that part, right? Is the fact that it's not intrinsic to the property. It's theoretical in the sense that the schedule 27.5 years that now you get to now take as a tax write-off your entire building over that period of time, a little bit every year for 27 years, starts the day you buy the property. It doesn't start when the property was built, because if it did, right, you go ahead and you buy a building that was built in 1970, guess what? 27 years is long past. You should have no depreciation deduction. It's already been fully depreciated, right?
Yeah.
So therefore, it's not true. Really, it starts over from day one. So the IRS gives us this tax deduction based on the fact that things go down in value as time goes on. So that's, in a nutshell, what depreciation is. It has a useful life, but again, it's just theoretical. As opposed to, so I'll leave it there, and then I'll see if you guys have any questions on that, and I'll segue into where cost segregation comes in.
Yeah, the way I've always kind of described it to newer passive investors who are trying to get their head wrapped around it is it's a phantom expense, where it's an expense that only shows up on your taxes. Like, you never cut a check to anybody to pay for these, depreciation expenses. However, when you go file your taxes, all of a sudden there's this nice little expense line item that drops your taxable income down, which is great.
Exactly.
So
exactly.
It's a really counterintuitive concept though for people, especially if they're newer to investing. The fact that something's simultaneously going up in value, but then when you go and file your taxes, you apparently lost a bunch of value to depreciation. Like, how does it appreciate and depreciate at the same time? But
yeah,
I guess it just comes down to the fact that the government wants to incentivize people to invest in real estate. So they build this big fat incentive to make it worth your while. But it's a fantastic tool. And, then we can get into the details here, but beyond, just having that depreciation aspect, you can even ramp it up and you can cram that all into the earlier years, which is where you come in, right?
So
exactly.
So real quickly, for a passive investor, somebody who's brand new off the boat right now, and this is the first time they've heard of depreciation and cost segregation and all this, is how does this directly pertain to them and their income? Like, this all sounds great. They're like, oh yeah, depreciation. Okay, that's a thing. What of it? What's that actually mean to me?
Yeah, absolutely. And what is depreciation? Yeah, let's break it down. Depreciation, just give you an example, because if, let's say you guys bought a building for $1 million, right? And you can just multiply this, the numbers, if it's 5 millions, it's just multiplied by 5. Again, just to give a quick example of how this works and then how it's going to affect everyone who owns part of that property as a passive investor. We subtract a certain amount for land. So let's say it's 20%, okay? It's usually can be 10%, 15%, 20%, just to keep the numbers even. So we're left with $800,000. That's the amount that we can write off, right? Now, every year for 27.5 years, we take a little bit of that. So you divide that, 800,000 by 27, it's approximately $29,000. Okay, just to keep it easy, we'll make it simple, $30,000. Okay, let's say you make on the property $50,000 of net operating income. Okay. So how depreciation works, like Dan said, it's a phantom expense. You subtract from your net operating income, from the amount after all expenses, you then have depreciation. So you have $50,000, subtract 30, you're left only having to pay taxes on the remaining $20,000. Okay. So how this works on the whole picture, you're an investor, passive investor, usually you get a piece of the ownership of the property, meaning you have shares in that and you're getting income. Okay, you're getting your return, whatever that is, 8%, I don't know what it is. You're getting that return. Now that return, you also get a portion of the depreciation according to your percentage of ownership, which means, let's say, just for all intents and purposes, you own the property, you own 10% of that property. So you get $5,000, just to keep it very simple without passive, LP and GP, and what's the split, everything. You made $50,000, you get 10% of that, you get $5,000 of income, right? You get $30,000 of write-off, you also get $3,000 of that income. So basically you're making $5,000, only paying taxes on $2,000. In a simple sense, that's how it works. it's going to be a little bit different. Obviously, what's the split and the breakdown of, the returns. But essentially what you'll do is you'll get a tax form at the end of the year called a K1, which will show exactly that. It will show what your returns are, what your income from the properties, and then what are the expenses to offset that. On regular depreciation, it's going to, reduce your taxable income significantly, right? Mm-hmm. While now cost segregation comes in and it's going to reduce it even more. Okay. So cost segregation, let's just understand the name. The cost, okay, you bought the building and you paid $10,000, $1 million for it, right? That's the cost. But segregation is we're splitting up that property into different components. We're segregating out the assets. So what the tax code says, right, you can depreciate the whole thing over 27 and a half years. But really, if you look deeper in the tax code, it says that there are different things in a building or in a property that actually have different schedules, different depreciation rates. So the structural components actually are the only things in the building that are supposed to depreciate on that 27 and a half year schedule. So it's things like, the ceiling, the roof, and the floor, and the walls, and windows, and doors, and main electrical, and main plumbing, all that stuff. That's like the main structure integral to the building. That value of that you're taking as a tax write-off over 27 and a half years. But there's stuff like personal property, which depreciates on a 5-year schedule. Land improvements depreciate on a 15-year schedule. So personal property stuff like, furniture, fixtures, appliances, cabinets, right? Special purpose electric, you have, wall coverings, carpeting, okay, vinyl flooring, all that stuff. It's not intrinsic to the building. It can be taken away, it can be moved, window treatments, all kinds of stuff like that. All of that, the value of those things depreciate on a 5-year schedule, meaning if you can identify what the value of all those individual assets are, you can now take them as a tax write-off in the first 5 years. So that's essentially what a cost segregation study does. It has an engineer, someone who's well-versed not only in building construction engineering, but also in the tax code to know every little detail of every asset in the property, what its useful life is, and now how to apply a value to those useful life and take that as a tax write-off up front.
So when you're saying
instead of taking that,
they got excited.
I know.
Instead of taking that $800,000 and dividing over 27 and a half years, you're effectively taking a big chunk of it, maybe like $500,000 over like 5 years. So that $30,000 phantom expense you were getting is all of a sudden like what, $100,000 or something like that? Yeah,
exactly. So yes. So let's break it down again. Let's take our example again, right? You had $800,000, right? I wish I had like a whiteboard here, but you have,
I got a calculator.
and then you can just to show on the screen for everyone else. And you have the $800,000. Remember our example, we had $50,000 of income. Regular depreciation got you $30,000, but let's take a very conservative approach. And let's say there's only 20% of the building is going to fit into that 5-year category, right? So we're talking $160,000 of extra depreciation in those first 5 years. What that translates to is instead of $30,000 depreciation each year, you're getting, essentially $80,000 of depreciation against your $50,000 of income. So what happens is you have more expenses, more depreciation than you have income, right? Which means you pay 0 taxes because you no longer have any taxable liability. And what happens to the rest of it, if there's any left over, is that it just carries forward. So you could use it next year, or you could use it against any of your other properties if you have other properties or other income. For the passive investor, it's going to be limited to properties, because
it's got to be passive income, right?
Passive income, exactly. Depreciation can be used against passive income. So any of your properties, any passive income, then this depreciation can be used against. However, if you're a real estate professional, which I presume some people, maybe you guys are, maybe people who are fully involved in the real estate business, then you can actually use those deductions or extra deductions beyond the income from the property to now offset any of your other active income or your spouse's.
Mm-hmm. Yeah, and I think what's very interesting as well is like when we start talking about this, a lot of people newer to investing think this sounds like some kind of like sketchy loophole, like you're trying to like scheme the system, but really like you're actually required to do this by the IRS. Like this is like legally you're supposed to do it. Like they don't enforce them. Like if you don't do cost segregation, no one's going to come and get you, but it's like the opposite of a loophole. Like this is actually like required by law. You should be cost segregation.
Yeah, this is the right way to do it. And what's really interesting is if you didn't do cost segregation, let's say you owned a building and you just were taking straight line depreciation in that 27.5 year category. And then for a couple of years you were doing that and you heard about cost segregation, you decided to do a cost segregation study retroactively. What you do is, and this is the really interesting thing, kind of playing on what you said, Dan, that it's the actual real way to do it. You have to file a form with the IRS. That's called the change of depreciation method. Okay, it's called a 3115 form. It's the change of accounting method. And so you're saying I was using this accounting method of depreciation for the straight line 27.5 year, everything. And now I'm changing that to doing it the right way, right? Cost segregation. There's a box you check. Okay, there's two boxes. The box is, was I doing it in the proper way and now I'm doing it to an improper way, or was I doing it in an improper method and now I'm doing it to a proper method? I'm changing the accounting method, but in which direction? So when you're going from the old way to doing cost segregation, the box you check is I was doing it in the improper way and now I'm doing it the right way.
So who actually answers that I'm doing it the proper way and now I'm going improper? Because that seems like something you don't admit on a form to the IRS.
Yeah.
That's what we're doing. And yeah, it's crazy. But like you said, they don't enforce it because for all intents and purposes, they get more money, right? You take less tax deductions.
Yeah. If you make a mistake in the IRS's favor, no one's going to bat an eye. You'll never hear about it. If you even come close to making a mistake where you owe them money, they're going to come find you.
Oh yeah.
I didn't know you could do it retroactively though. I thought if you missed taking advantage of this in the year that you purchased the property, like you're SOL. So you can actually do it retroactively.
You can do it retroactively. Not only that, like I said, you don't even need to amend any previous year's tax returns. All you have to do is file this form of accounting method change. So you can
and then the deduction goes forward then?
The deduction goes forward, but it also brings what you missed. So you get to catch up on depreciation. So let's say in our example where you had over 5 years, you were supposed to take this extra $160,000 of deductions. Right, for the first 2 years, you were just taking 30 grand, and so you missed out on 160 divided by 5 is 8. Yeah, you missed out on the first 2 years of that 160, which is essentially 40,000, something like that, $40,000 of extra depreciation. You can now get that in the first year. So on top of your regular depreciation, you get all that accelerated depreciation that you missed, and essentially you get an extra, $90,000.
That's crazy. That's great.
So how long is that window that you can go back retroactively? I assume you have to still own the building, obviously, but is it at any point in that journey?
It is at any point. You can go as long as there's still depreciation to be had, but it really only makes sense depending on the size and shape and type of property. Usually it makes sense to go back five years or so.
Mm-hmm. Yeah, that was something else
that you're missing out.
Yeah, something else I was going to ask for is at what size does it really make sense for somebody to pursue cost segregation? And then also, is this something that people can do on their personal properties, or is this only for commercial aspects?
Yeah, so great question. So to answer the second question first, this is not for your personal residence. So the only type of property that this does not apply to is personal residence. So if you own any type of investment property whatsoever, or a business property, okay, so let's say, and this is something that people don't even think about, and this works for any asset class, any type of property. So not just multifamily. I mean, you guys are talking multifamily people, but this works for anything, commercial, retail, office, self-storage, warehouse, doesn't matter what. But business properties, let's say you're a doctor and you own the business, you own the building that your office is in, and maybe you rent out a space to another tenant, but your business owns that property, you have depreciation from that property. So you can actually do cost segregation on that. Let's say you own a warehouse because you're in the manufacturing business. You don't consider yourself, and the doctor, doesn't consider themselves a real estate investor, right? That warehouse, that factory owner, the manufacturer doesn't consider himself a real estate investor. He happens to own the building that he manufactures out of. You still can do cost segregation on that building. So that's to answer the second question first. The first question, which is at what size, what point does this make sense? Usually, and it's really a numbers game, so you can really see for yourself when you kind of run those numbers and you see the numbers. And one of the things we do is we run free estimate beforehand So you can actually see those numbers. But anything over $500,000 purchase price is really where you're going to see it. There's going to be a lot of benefit there. And the higher you go, meaning the more the property costs, the more benefit there is, because it's just proportional. It's a percentage. So if it's 20% on $1 million, extra 160, 20% on $10 million, you're talking a couple $1 million of tax deductions. It just inflates as high the higher you go.
Yeah, I'll say on my very first property I bought, it was a 6-unit up here in St. Paul, Minnesota. I bought it for $475,000, and it was well worth it for me. I think the study cost me like $4,000, $4,500 or something.
Right.
But because I was a real estate professional, I could wipe out my wife's income as well at her W-2 job. So,
Exactly.
that was the first year I've gotten a tax refund since college. And it was pretty cool because I was used to paying, 20, 30 grand a year in taxes. And all of a sudden I'm getting money back. I was like, this is cool. So, I mean, for me, it made sense there because I had that real estate professional thing and I could wipe out some of my wife's W-2 income. But I mean, honestly, these studies don't cost a bunch of money. And the break even's pretty low. I mean, I think anything above like a duplex is usually probably worth it. If $500,000,
Yeah.
I feel like a little bit under that, you're probably good to go.
Yeah. I mean, the thing is, the reason why I say $500,000 is because, like you said, it does depend on your situation.
It
for sure is going to be a break even.
Income that made the difference on that too. If it was just the money I made on that one property, probably wouldn't have been worth it. But if it was our income collectively, I think that
right. And it's more than just the break even point, because you don't want to just spend a few $1,000s to break even, right? You want to make sure that it's worth your investment. And not only that, we're talking about here creating more tax deductions or front loading tax deductions. But at the end of the day, you're not creating deductions out of thin air. And if you can use them and they're going to create a net value to that, meaning you're going to pay less taxes. So you're actually saving, how much you're saving on taxes is less than the actual deductions themselves, right? Because if you have $100,000 of deductions and you're paying a 25% tax rate, so you're really just saving $25,000 in taxes. You're not, so, it sounds like this huge, it's awesome. You're creating like hundreds of thousands of dollars, but in the end of the day, what's your bottom line? How much are you actually saving? So that's why I like to, I don't push it if it's anything less than that. Obviously, there's situations where it can be beneficial. But
so is there a rule of thumb on, like I've heard people say that it's 30% of the property. So like we have an $11 million property, you're looking at, what, 3-point-something million dollars in depreciation through a cost segregation study. Is that a fair assumption?
Are you talking about the year one bonus, or are you talking about
with the bonus depreciation?
Wait, what? We have just jumped too far ahead of my education here. What is this?
What is bonus depreciation? This is magic.
Dropping bombs over there, Rodney.
I know this is the way we roll, though.
That's true.
So let's talk about bonus depreciation. Let's fill in Anthony. So like I said before, you get with the cost segregation, the engineer will come and identify all the things in the property that depreciate on a faster rate. Okay, so there's the majority of that's going to be in 5-year, the personal property. There's other categories like land improvements that depreciate on a 15-year schedule. That's like landscaping or pavement, fencing, sewer grates, whatever it is, anything outside the building that's not land itself, but land improvements. All that stuff is now eligible within the tax law for 100% bonus depreciation, which means you can now take the entire amount of anything that's accelerated to those faster rates. You can take the entire amount in year number one. So instead of spreading that, $200,000 or $300,000 over a 5-year period, you can now take the entire amount in year number one. So that's what Rodney was getting to. If there's a rule of thumb in terms of the percentage of allocation for multifamily buildings, it's usually somewhere between 20 and 35%. I'd say usually somewhere closer to 30 to 35%. Again, it depends on what type of property it is, how much land improvements there are, et cetera. Like on a city building where you're just like concrete and then sidewalk and that's it, there's going to be very little land improvements there. So, but yeah, that's a pretty good rule of thumb. If you're talking, 20, 30% easily. So yeah, $10 million building, $3 million first year write-off.
this is one of my favorite topics whenever we talk about the depreciation and cost segregation side of the things, because it feels so much like a Billy Mays infomercial where it's like you first learn about depreciation, then they're like, but wait, there's more. And then you learn about cost segregation, then they're like, but wait, there's more. And then you learn about bonus depreciation, and it's like it feels too good to be true when you first learn about it, because you're like, wait a minute, this, again, going back to Dan's point earlier, it feels like we're exploiting some loopholes here, when in reality, like it's the opposite of the case. And bonus depreciation is a fairly recent amendment, right? Within the last 5 or 6,
Correct.
5, 4 years.
Well, the bonus part's newer, but
but not cost segregation, but bonus.
Right. Yeah. Bonus depreciation is with the Tax Cuts and Jobs Act. So at the end of 2017, 2018, that was when this was put into place. It used to be, it was like an old law that was updated. So it used to be something that just was for new development. So new construction or new development could take a 50% of bonus depreciation in the first year. They changed it, any property, any acquisition whatsoever, and up to 100%. So so that's a new thing. And you're right about the fact that it gets better. The more you learn, the more you educate yourself, it's always going to be there's more. And even all that we've discussed, there are more elements to it that actually make it even better when you're looking at this from a kind of wholesome perspective of real estate investing, as opposed to just kind of looking at it in a box, cost segregation by itself. When you're looking at it saying, here, this is a tax strategy, but when that's why you have to have a tax advisor. You have to have, a CPA, someone who's not just filing your taxes, but is actually helping you to understand all these quote unquote loopholes that are not loopholes. They're really built into the tax code themselves to benefit you. So you want to see who's going to get the benefit. Look around the country and see who are the wealthiest people in the country, and really anywhere in the world, and you'll see the real estate investors. And one of the reasons why is because of the tax incentives that are there. And so like Jared Kushner, right? There was a New York Times article a couple of years ago. I remember I saved the headline where it's like, Jared Kushner hasn't paid federal income tax in 10 years, right? And if you read the article, it's like he has a net worth of $300 million and he hasn't paid income tax. And what they're trying to do is trying to say how he's doing some tax evasion. And like in so many words, that's what they were trying to say. But if you read the fine print, you're like reading, wait, no, he's just doing cost segregation, and he's doing other tax strategies within the law.
You see that about Trump all the time too. And like, regardless of how you feel about the guy as like a person and his political views or whatever, like people talk down about the whole tax situation. It's like, no, he read the rule book and he played by the rules, right? Anybody
and those
can
rules
do it.
Are available to anybody.
Exactly. You can complain about it, or you could take advantage of it too. I mean, they're there.
Dan, you know that section in Tom Wheelwright's book, right, where he's talking about the tax code.
Yeah, it's just one big.
Where it's written for you to be able to keep more of your money. Is that?
Yep, that's the section. Yep.
Yeah.
Yeah, and I think this is like one of the best topics for me when it comes to real estate. It's like the tax thing. It's not the sexiest. It sounds the most boring. However, it's what makes it's what sets real estate apart from every other investment you could be making, with the exception of drilling for oil, because it's what enables you to accelerate your progress so much. I mean, when you take away that tax burden, whether you just reduce it or you pretty much eliminate it, if you're really doing this effectively, like if you compound that over 20, 30 years, it's insane. Like if you take away that tax burden, you're going to take you could take a couple $100,000 today, invest it over 30 years, and in scenario one where you're paying taxes like the average person, you might get up to $10 million. The guy who's paying less or almost no taxes is going to have 10 times that by the time he's done. So it's insane how much that compounds over a lifetime of investing. So it doesn't sound that exciting when you're talking about reducing your taxes. It's like, okay, whatever. But like the numbers are insane when they're compounded over like 30 plus years. Absolutely insane.
Yeah. And even on a short-term scale, like think about it. If you had an extra $100,000 to invest this year, like what could you do with that?
Yeah. I mean, in real estate, as for a passive investor, pretty common to make 20%, right? So you have an extra $100,000 lying around, that's extra $120,000. You keep doing that year after year, that adds up a lot.
If you have 120 grand laying around, Dan, can you front me some of that? Or
yeah, I'll Venmo to you. It's on its way.
Wait, Dan, you're my partner. What? Send your money my way.
Don't leave me out, guys. What's going on?
We got to pay Yonah for his services too.
I'm the guest. I'm the guest here.
I'm Venmoing everybody now.
Isn't
if Dan's just handing out money,
Yonah, isn't it like guests first or something like that?
Exactly.
Yeah, it would be polite. And he's repping the brick background. So
something I wanted, this is a little bit of a tangent sort of, but one of the questions I wanted to ask before we even went on the air was, how do you choose a cost segregation company to work with? What should you be looking for? Is it just a matter of price? Is it services? Is it like, does the person have like a rock star beard? Like, what is it that I should be looking for?
Best beard.
You want to make
best
sure
beard,
they have, you want to make sure they have a beard. You want to make sure they're very active on LinkedIn. All the top tier questions. No, really what you're looking for. And this is something interesting because, you're asking, well, what do you look for? What's really interesting, and Dan, to you, like, a few years back when you bought that, that 6 unit, right? Like, what I'm just asking you, you can answer whatever you want, but for you personally, like, did your accountant like tell you about cost segregation?
No, can't remember. It was through, research and podcasts and reading on my own. Like, no one told me about it. And,
right.
Honestly, I met this guy at a networking event and, he was there. And then I was like, okay, well, I'll shop around a little bit. Called 2 other shops and their price was higher. So I went with the guy with the low price.
But the point I want to make here, the point I want to draw out is that your accountant is not necessarily going to be proactive to tell you about cost segregation, right? Yeah. Which is really interesting because most accountants are just filing taxes. That's what they're doing. They're not necessarily tax strategists, especially if they're not real estate tax advisors. What's most interesting when you find a cost segregation company, so there are tax firms out there that will do it in-house. There are like very large accounting firms that they do it in-house, have engineers in-house specifically for this purpose. Regardless of that, you're going to have a number, there's a handful of companies out there that are on a national level that are doing, thousands of these all the time. The main 4 things that you're going to want to look for, because there's also these kind of fly by night and people just trying to do it and figuring out how they can do it. Number 1 is that they'll offer you an upfront evaluation. So upfront what you're looking at, what you're gonna get, even before you spend a dime. Okay, so you already have that educational piece. You want to make sure they're providing that, which I think most people do. You want to make sure that they have dual in-house, engineers and accountants, that they're doing it in-house. They're not just outsourcing it to India or whatever, like someone. That's really integral to it. And also because it streamlines the process. And there's no, cutting corners in that. The third thing is you want to make sure they have audit protection. So what I mean by audit protection is that if God forbid someone were to be audited, they're going to take a look at everything and they're going to look at your cost segregation study. You want to make sure that stands up to the IRS's rules, and they have a whole guideline, the cost segregation audit techniques guide, and everything in there that needs to go in there. So make sure that they have that audit defense. Okay, meaning they'll stand up for you, they'll defend their thing, whatever, without any extra charge also, because that's another thing. Like, oh yeah, we'll do it, but we'll charge you, $300 an hour to do that. And the fourth and final thing is just the experience, right? Like, you want to make sure that you have people that they know what they're doing. They've been doing it for a long time. They have a good track record. And, to be honest, the price point is obviously an important part also. But in the end of the day, if you're getting the quality of that, if it's a slight bit of difference between the quality and not, obviously it's probably worth it for it. With that being said, most of the national, companies like Madison Specs, and there's a few others out there, the same kind of scale, are pretty much around the same price point. It's pretty comparable because there's a competitive market, right?
Yeah. Now, do you work with, because you're in I can't remember if we were live when we asked you about your location before, but you're out on the East Coast, right? But you worked with guys across the country, I'm guessing, right?
Yeah, so we're actually the largest national company. So we work in all 50 states. We had, definitely the most volume of any company out there. So we did, like in 2019, for example, we did over, I think, 2,800 cost segregation studies. So
Wow.
all across the country, doesn't matter where, we'll send our engineers wherever they'll go, which now, believe it or not, we actually, because of the current situation and travel restrictions and, just the uncomfortableness of people coming onto your property, we've developed like a virtual site tour, which we've kind of rolled out and have been pretty successful. We've already in the past like month or so, maybe 6 weeks already. By now, we've done probably like 500 of them already. And it's been very successful because it allows the technology that we can have kind of a video tour. The engineer can be on one end and kind of direct whoever's on site to show them and take a video and measurements if they need, if anything and everything that they would have looked at anyways had they gone to the property.
So you have the owner walking through with a camera or something, or is it
the owner engineer? Or property manager? Well, usually we'll have the engine. When we send someone on site, we have the engineer will do that. But now with the virtual, we're having someone who has access to whether it's the owner, or property manager, maintenance person, someone who can walk them through.
That's interesting. Yeah, I was just getting the ball rolling on a refi for next week actually, and it was surprising. The appraiser was like, yeah, we're not actually going in the building, just send us pictures of the units. I was like, okay. Like, why am I even meeting you there? I mean, here's the rent roll, here's some pictures. Like, why do we even need to go? I guess, they still look at the common area or something, but it's just weird. They're just like, they don't go in the units now. It's like, okay.
Mm-hmm. You have to walk every unit, Yonah, or do you guys just like say, I want to see a 1-bedroom, a 2-bedroom, a 3-bedroom, and the clubhouse and the common grounds and go off of that?
Before actually jumping to that, because that's really great, but maybe we can take it one step behind that and say, for like an active investor, their first time, what do they need to have in order, like when they want to call you, they're like, yeah, this sounds great. What do I need to have ready to have the conversation? And then what's the process look like? And then from beginning to end, what can they expect?
Yeah, it's pretty straightforward. I mean, it literally is. It's pretty straightforward. Like I said, we do the first thing we do is run an estimate and analysis. And with that, we'll require to have just the address of the property. We'll use our data sources to find out, square footage, the unit count, unit breakdown, stuff like that. An appraisal will help with that as well. But basically address, the purchase price, the closing date, those 3 data points will give us enough information. We can get the rest that we need to run that analysis. Once you have that, like I said, that's like an educational piece. You see, I'm going to pay X for this. This is going to be my tax deductions. Does it make sense for me? Does it not? If it does, let's go forward. We'll engage. We'll send an engineer or do the virtual site tour, whatever it is right now. 6 weeks or so turnaround time for us, and we're working on processes to fasten, to make that faster as well. But you get your report back, a 90, 100-page report, which has in it a new depreciation schedule. So instead of that straight line that your accountant would have done and said, this amount every year for 27 years, we'll have a breakdown of that into different categories, and then we'll have the bonus depreciation schedule as well, and you can choose which one you want to use at that point. And that's it. That's it. It's literally like a 3-step process. We collect a few pieces of documents just to kind of verify facts, like a closing statement, an appraisal if you have it, just so we can verify those facts that are, because this is going to the IRS, you need to make sure that everything is factual, and that's it. So pretty simple.
Yeah, I love for you guys at home that are maybe new, that have never done this before. Like, there's really low barrier to entry here, because you can get the appraisal, the upfront evaluation, and then make the decision. So you have nothing to lose by at least reaching out and having that conversation. And it's, if it works out, great. If it doesn't, well, now and knowledge is power.
Yeah, and honestly, with anyone in that camp who's thinking about, like, is it worth it? Like, to get that free estimate, you don't even really need, it might be different with you guys, but from my experience, you don't even need the appraisal, and you just give you guys the address, and you get a really good idea of what the numbers are going to be. And then, to your point, either the numbers make sense or they don't. Either you're going to be spending $5,000 to save 20, or you're going to be spending $5,000 to save $2,000. And then it's just a matter of, are you coming out ahead or not? So it's like,
should I do it then?
Downside. Yeah.
What's the threshold? When should I do it?
It takes like 5 minutes to get on the phone and ask for a free estimate, and you guys could probably spit it out pretty quick. So it's dumb.
And I'll be the first one to tell someone, like, this doesn't make sense. Like, don't do this. Like, this is not going to benefit you. A guy reached out to me and he said his accountant had suggested that he do cost segregation. I'm like, okay, well, send me so this is one other thing that you need if you had a property that was already purchased in a previous tax year and you want to do the retroactive thing. So at that point, we'll need one more piece of information, which is a depreciation schedule. So if you already filed taxes, we'll see that, because that will tell us what you have left. And so one guy, I said, yeah, send me the depreciation schedules. He sent me depreciation schedules, right, from his tax return. And I looked at them like, why did your accountant tell you that you should do cost segregation on this? There's like nothing here. There's like very little, it was like, whatever, there was like a huge land, it was like a fourplex, and he ended up, the land allocation was like 50%. And then,
wow.
And then he had already had it for like 4 years. And so there was like, you're not going to get any, what was your accountant thinking? He's like, yeah, I have no idea. I don't know. Just had
a bad accountant.
Yeah.
Now you're talking
wait,
about.
Wait. Well, in the accountant's defense, he recommended cost segregation, which Dan, your guy, didn't do.
Right. So in that particular case, with you're talking about, because it was a fourplex, but if you're in year number 4 and you have 100 units, is that different then?
Sure, absolutely. So there were a few factors in this, and it was kind of arbitrary to throw those numbers out, but there were a few factors in this guy's case that just didn't make sense. But yeah, of course, if it's a 100-unit
land
building,
allocation in and of itself is ridiculous.
Ridiculous,
50%.
yeah.
Yeah.
So it was like it was like a $400,000 or $500,000, $500,000 purchase, but like half of it was put to land, so there was not much left over to begin with.
Yeah. And you can't undo that even if it's wrong, right? You're kind of stuck.
If you do, it's not like 100% stuck. Once you file taxes, it's pretty much set in stone. To change that will be difficult. You could, but you're gonna need to like back it up and defend it, and be prepared that if you get audited, you're gonna have to be able to defend that, and you're gonna have to have a good reason why it was changed. Maybe it was a mistake that they put it in at 50%. Maybe it was, you had an appraisal and the appraisal says it's really 30% and they put it at 50%. I had a guy in California. California is notorious for high land values. And there's been a lot of court cases, tax court in this subject. And this guy was like, listen, we put it in, we did it, we made a mistake. It was like, they had like 60% land allocation to one of his properties. And he's like, I don't care, I'm going in, I'm changing it. I have a tax attorney, we're gonna fight it. And he did. I said, listen, it's your responsibility, right? It's your taxes. If you want to change that, you have go ahead.
Now, just so that I understand it, this is when the sale is recorded that allocation takes place?
No, it's usually, there's no real method of allocating land. Okay.
Well, it's like the first tax return you do with your CPA when you buy it, right?
Right.
That's when it's like, okay, here's what's land and here's what's building.
That's when it's set in stone. But he's asking, at what point does that even allocation get established? That's when it gets set in stone. Once you file taxes the first time, that's it. You really can't go back. But where does that number come from in the first place? There's really a few different methods, and the IRS doesn't say any which way is right or wrong.
My CPA asked me. I was like,
exactly
25%. It just sounds good. I don't know. See if someone comes back and fights it, but
right. So you can look at county assessments. You can look at the property tax and see what the assessor is always going to have a difference between land and building. You can look at appraisals. Will usually give a land allocation. So there are a number of methods that you can come up with that number. But once you do decide on that, right, you really can't go back on it.
The most I've seen is 30%, like the most realistic, other than like the 50% you just mentioned. Like the highest end of normal, I'd say, is probably 30% for land. But
yeah, and we see the national average is usually around 15%.
Oh, Okay. So I shouldn't have said 25 when he asked me. I should have said 15.
Could have said 15.
Corrected.
It'd been okay.
It's a lesson going forward there.
Now I know the national average. I love it.
Hey, there it is. There it is. There's the thing that Dan learned in this episode. So we did it.
I learned a lot of things. That was
Yeah, I
just
did
the
too.
most recent.
Yeah, this was-
so.
Should we do that as a
really good.
featured set? What Dan learned on this episode?
You're gonna quiz me at the end now?
All right. Well, we're getting
getting
close to the top
closer.
of the hour. Is there anything you guys want to talk about before we call it a show?
Well, we should probably let everybody know if for some reason they don't know where to find Yonah. We should probably let them know where this guy hangs out.
Have you guys ever heard of LinkedIn? Just go there,
It's like
hang out for 5
but
minutes, and
newer.
eventually he'll pop up.
I'm on TikTok now.
Oh, nice.
No,
Are you dancing in the airport?
I'm not really. No, I interviewed someone on my podcast. So I have a new podcast called Weiss Advice. And I interviewed someone today. It's not going to air for a little while, but he was telling me that he started on TikTok 3 weeks ago. Okay. And I'm like, you're a dancer? He's not a dancer. He's like, I haven't posted a single dance whatsoever. He's like, you have to understand, there's so many business people on TikTok. It's just another media avenue. It's so many eyeballs. He said he posted a video in 3 weeks. He has over 40,000 followers, and he posted a video that got over 1.2 million views. Mm-hmm. So there's a lot of eyeballs. Yeah, there's a lot of eyeballs on there. And at the end of the day,
I guess the thing that I would say is, what kind of eyeballs?
Yeah, I mean, we utilize TikTok on our in my other businesses. So
I assumed all the eyeballs on TikTok were like 12, 13-year-olds. Like,
well, that's what
they are, but there's also like an older demographic as well. But just think about the long play there. Like people get older, and
that's what this guy was saying. He said, first of all, two things. One, it was between 12 and 15. That was like the average viewership. But because of the quarantine, the pandemic, a lot more people started using it, and the demographic shifted to between more like 14 and 22 is like because a lot of college students like went into that. So now you're looking at that and you're like, okay, like you're saying, Anthony, what about the long play? What about 5 years from now? Who are those 18-year-olds going to be in 5 years from now? And if you get involved now, this guy was telling me, like, if you have hundreds of thousands of followers, you're going to have that currency, and you're going to be able to.
That makes sense. I mean, when Facebook first started, like you couldn't get on it unless you had a college email address, and now like everyone's mom's on it. So
yeah. And it's, Yonah can speak to this, is like social media is all about the branding and the networking and the conversations, and that you really want to position yourself in people's minds. Like Yonah Weiss is the cost segregation king. Like that's what you're doing when you're on these platforms. You're not trying to make the sale. Like you're not trying to sell a 16-year-old on, hey, come passively invest in this product. You're trying to position yourself in their minds so that maybe in 5, 6, 10 years from now, they're like, hey, I've heard about apartment syndications because this one guy, this one time I saw way back in the day and it was interesting.
Right. Or maybe they have a cousin or an uncle or whatever. And like it comes up in conversation, and because they remember you, because you're in front of their face and you're the one that gets their attention, you're going to be the one that they think about.
Yep.
So I can't tell you how often I get like random, messages and LinkedIn and emails and whatever, just like, oh, I saw you on a podcast. I heard you this and that. It's just about getting yourself out there, putting yourself out there and establishing that brand.
I love it. Anthony, I got to Google how to do TikTok now, because I feel like we need to get on this thing.
Be careful, man. Here's the thing.
It's a time suck.
We would kill on that. First of all, there's a particular demographic that would very much like you on TikTok. Like you would dominate, Dan, but it is a time suck.
Is that
you
good?
will lose. No, it's a great thing. Yeah, you'd do great, but you will lose like an hour of your life like that. So you just gotta be careful.
Well, I don't want to consume content on TikTok.
You have no choice.
Is that okay? All right, that's a whole nother can of worms we'll get into on next week's episode.
On any platform, you have to consume before you can really post anything.
Yeah, exactly.
Because you have to understand what works, what doesn't work. And
I've been proactively avoiding TikTok, so I guess I should
same here.
Yeah,
It's
being successful on any social media platform is all about contextualizing your content for the people and what they're there for. And step one of that is understanding how to speak the language. And you can't just show up and just expect what's worked on LinkedIn to work on TikTok and shove it down people's throat because they're like, nope, this isn't how we consume it here. Like, get out of here, old man. Then we go away with our tail stuck between our legs.
Yeah, and that is you know, you have the Facebook, and then you've got Instagram, and then you have the TikTok, and that would be the span of the age. It seems like, you know, you get TikTok the younger, and Facebook, which used to be tons of young people, and now it's
old people now.
It's all old people.
It's everybody, honestly.
And young people are not on Facebook.
Yeah, Dan, they're not. Yeah, like 20 and unders.
I wasn't trying to talk to those people anyways. People under 25 kind of irritate me. Full disclosure.
Full disclosure. he just had a kid too, so
not yet.
No, not
it's coming.
December 2nd.
It's in the
that's right.
That is an exception. Collins will not irritate me, but every other person under 25 will most likely irritate me. Not gonna lie.
Yeah, what did you back in August you found out you were gonna have a child? Was that what it was?
In August?
When
August?
was it?
No.
April.
Dude, babies don't take that long.
I'm all.
No, there's nothing in the oven in August. We found out, I think it was March-ish. Yeah, it was like late March, I think.
Okay.
So like full on quarantine. So we were hunkered down, and then we were like, oh, having a baby. Look at that.
I want to talk to you after that child is here.
I'm going to have a lot of questions for you and anyone else who has a kid, because this is number one. So lots of questions.
I have 6, Yonah. So
I have 6 as well.
Oh,
nice.
All right, you guys know what you're doing. I got
Rose over here.
At least on the
high scores
part we do.
I just need to understand the first few months, and then we'll get to the next.
I tell you what, the learning never stops, because everything it all changes. I asked a guy one time, I said, so now that all your kids are left the house, are things calmer? And he said, no, their questions are more complicated.
They have adult problems now.
Yeah, exactly.
Hilarious.
Yeah,
exactly.
Right, yeah.
Well, Yonah,
so
we want to thank you for this time. Did we get where to contact you besides
we didn't
LinkedIn?
get the specifics.
Yeah,
we established that you're like the king of LinkedIn.
How to get in touch with you.
We need handles. We need links.
You can go to yonahweiss.com. So that's a good place to start. You can basically contact me through that. You can LinkedIn, Yonah Weiss. There's only one of me. I mean, come on. And I stand
if you're looking
out.
for
So
good content and good educational pieces, check out his new podcast, Weiss Advice, which I think just launched maybe a couple of weeks ago, but you already have like 65 reviews. So you have some kind of like
and a star easy up too.
Yeah, it's well done. That's a solid launch.
I have so many amazing guests. It's incredible, and it really just speaks to that literally every single one of those people. People ask me like, how do you get guests on your podcast? And I'm like, I just ask people that I know. And I'm blessed to have such an incredible network of people that I literally just like ask them like, hey, launch your podcast. You want to be a guest? Like, yeah, sure, of course. So yeah, thank God it's been good. It's been a good launch. I'm really looking forward. I have like another 30 episodes that I've pre-recorded, and I'm just like anxious to just push them all out, but I don't want to like oversaturate it.
You don't want to do the Netflix thing and just jump on it so everybody can binge listen to Wise Advice.
No, this is not Netflix. This is HBO style, once a week. Trickle it out.
Trickle it out.
That's how you know it's good content, when people wait a week for the next one.
Mm-hmm.
I love it. So, well, thanks for coming on, Yonah. I've been meaning to connect with you outside of just a random LinkedIn message for a long time. So I'm glad we got to connect. I got to learn about the backstory of how you became the cost seg king on LinkedIn. So, and this is hugely informative too. I learned a lot, and very cool.
Awesome. Yeah, thank you guys. It's a pleasure. It's a lot of fun.
Well, thank you very much. And
until next week.
Thanks everybody for listening.
Yeah.
See you next week.
Make sure and subscribe down below. Hit the bell so that you can
the buttons.
Aware of anytime we dropped in. Give us some reviews, some comments. We'd love to hear from you. Good or bad, hit the like button, dislike button, either one. Thank you,
Exactly.
everybody. We appreciate you coming by.